Hello everybody, welcome to Ask a Fund Manager. I'm Nick Pardini, and today we're going to be talking about option Greeks. And the reason why we're going to be talking about option Greeks is because a common question I get asked a lot is, why do options trade differently than their underlying stock? What factors drive options price beyond just the change in the underlying stock or futures or currency price? And that's what the option Greeks are. It's going to be a two-part series. First one, we're going to talk about the three main Greeks that are most commonly used: delta, gamma, and theta. And then in the next one, we're going to talk about a few more of the obscure Greeks in the marketplace. So the first Greek we're going to talk about is delta. Delta is simply just the change in the option value with the change in price. And so basically, delta is going to be always between 0 and 1. If the delta is 1, that means for every dollar a stock goes up, the single option will go up $1. And if it's 0, it means they're not correlated at all. The deeper in the money, which is basically the option is a profitable position, that your strike price is below if it's a call or above if it's a put, the underlying price of the given stock. So in this example, say if I have a $50 stock and the stock, my option contract, I bought it when the stock was trading at 30 at the money. So now it's deep in the money, and because of that, my delta is really high. It's effectively like owning the stock. Whereas I have another option in the same stock that's at $100, and since it's so far out of the money, therefore it doesn't move that much with the change of the stock, because the probability of it hitting 100 before the contract expires is low. And that's another way to look at delta. It's basically the probability that the market believes that the stock will trade over or under the strike price of your option. So that explains why, like, as the time length of the options contract shrinks, the delta tends to shift too. For out of the money options, delta declines, and for in the money options, delta increases drastically with time. It's because the probabilities get more fixed. And when you have higher volatility, the delta curve flattens because there's a bigger range of possible outcomes. So that basically explains delta. The second one we're going to talk about which kind of goes into this, is gamma, which is the change in delta versus the change in price. And I kind of mentioned this in the delta explanation briefly, but gamma is the second derivative essentially of delta, and so how quickly that's going to change. Gamma increases when volatility increases because the range of outcomes increases. That's what this chart here shows, that the flat, which I got from optioneducation.org is the source if you can't read that in the video. It's the flatter, there's a flatter, more but a fatter curve is when the volatility is higher, because there's a broader range of outcomes. So when volatility is lower, it becomes a narrower, steeper bell curve, because the range of possibilities becomes lower and it's more likely to stay within a certain area. So that's how the probabilities change with volatility. Gamma also is always at its peak no matter what when it's at the money, because if the strike price is the same as the underlying, any change in the underlying will move the delta the most, because it either goes in the money or it goes out. And then the further out you are, the less gamma shrinks. So basically, gamma is the greatest at the center point at the money, and then it decreases the further out or in the money you get, because it'll take a lot more to make that option come back to being at the money. The last Greek we're going to talk about in this video is theta, which is the change in delta over time, essentially time decay. So say if I bought an option for 3 months, part of the value of it is not just the potential in terms of volatility that's built in, or the fact that I have a chance to execute this contract. A lot of the value is just the time. It's the fact that no matter no matter what this, even if the stock goes, say for example, I'm buying a call on a stock that's trading at $10, that's $20. That's a $20 strike. So it may be only at $10 now, the stock, but the fact that it can reach $20 within the 3 months duration of my option is the vast majority of the value. And the deeper out of the money an option is, the more the value is and lower volatility is, the more the value is theta. And theta is simply just the longer dated your option, the more theta you have. And every day you lose a chunk of theta if you're long options, because the amount of time on your contract shrinks, and therefore the value of the contract shrinks because you have less time to get that contract in the money or deeper in the money to be worth more. If you are selling options, theta is your friend. Like a lot of the big vol selling institutions out there make fortunes selling theta. They just collect a premium over time. And since options are kind of like an insurance policy for a lot of investors, people are willing to pay such a somewhat of a premium just to be protected in case something adverse happens. And so that's where it kind of gives the opportunity for them to make money. But so theta, if you're selling options, is a premium you're collecting every day, whereas if you're buying options, it's the amount of premium you're losing every day. And theta is not uniform. I mean, I've done several studies on this, and basically theta accelerates over time. So, I mean, this is just based on a lot of academic papers I've read on this, so it's not 100% like the definitive answer to this question, but based on my research on this subject, it's on average about half of a option's theta is lost within the last 30 days. So if you are going to buy an option but you want to keep the position on, you should roll it in the last 30 days to minimize the damage of theta, essentially. But yeah, it's basically just theta is simply time value. It's a kind of a long equation, which is why I didn't put it on here, but the main thing to think about is how much shot clock do you have left before your position expires. And that's really all we're going to talk about in this video. Let me know if you have any questions, and if you would like to have any other topics discussed, you feel free to write a comment in the video, or you can reach us on email at askafundmanager@gmail.com. Thanks for watching, and enjoy the rest of your day.